Many investors in retirement are drawn to high dividend companies because they generate significant passive income. Also, dividends can increase annually to help fight inflation, in contrast to the fixed interest paid on bonds. Yet not all stocks paying the highest dividends are secure. Stocks with high dividend yields require more analysis in order to avoid yield trap investments due to factors including aggressive payout ratios, dangerous debt loads, and businesses in secular decline. Hey, welcome to Stock Market Mate. Today we'll talk about the best high-yield dividend growth stocks. To find businesses that can provide secure dividends, we look through the universe of high-dividend equities. These companies uphold responsible dividend policies, robust financial standing, and cash flow-generating operations. However, before we start the video, do like and subscribe to the channel to help us beat the YouTube algorithm. If you're done with that, then let's get started. Number 6. Vanguard High Dividend Yield, or VYM. Vanguard High Dividend Yield is the best option if you want a straightforward offering from the king of index funds with incredibly low costs. It strikes the sweet spot between the lower yield dividend growth options and the ultra-high payers where you find some risky troubled companies with a yield of a respectable 3.04%. We believe that it is a cut above due to its extensive track record, breadth, size, and unbeatable fees. According to Dan Soteroff, senior manager and research analyst for Chicago-based fund Morningstar, he loves that Vanguard is more diversified than rival funds, and it offers a much higher yield than the broader market. He also reminds people that the guidance he generally gives people is to start with the Vanguard funds. Of course, dividend-paying equities also have the potential to appreciate in value, giving you 2 more avenues to increase your wealth. Vanguard High Dividend Yield has demonstrated remarkable consistency over the long term, with returns of 8.86% annually over the last 3 years and 9.77% annually over the past 5 years. According to Rose Swanger, a financial consultant in Knoxville, Tennessee, the fund delivers a dividend like clockwork, making it an excellent choice for investors looking for a little income to boost total returns. Number 5. Schwab US Dividend Equity, or SCHD. Consider Schwab's flagship dividend option, which received 5 stars from Morningstar if the 3% yield of the Vanguard fund isn't truly lighting your fire. We like that its dividend is almost 0.5 percentage points higher at 3.4% and exceeds the average yield of the S&P 500, which is 1.67%. The main advantage of Schwab US Dividend Equity is that it is more selective than its broad competitors. Its screening for stocks with high cash flow to total debt, return on equity, and 5-year dividend growth rates show that it includes quality indicators in its portfolio. Soteroff of Morningstar claims that this fund strikes a fair mix between yield and quality. In general, the companies it owns offer a yield that is higher than the market while yet being financially stable enough to make those payments. The composition of the fund is therefore more concentrated than that of some other funds. In addition to the above-mentioned firms, the portfolio also includes well-known brands like Broadcom, PepsiCo, and BlackRock, each of which accounts for more than 4%. For instance, only a few firms even reach the 3% mark in the Vanguard High Dividend Yield ETF, which is our overall winner. With outsized returns of 13% annually over 3 years and 13.37% annually over 5 years, this targeted approach has earned a top spot in Refinitiv Lipper's rankings for both steady returns and minimal costs. Number 4. Realty Income. Realty Income was founded in 1969 and has paid dividends continuously ever since. It all began with a single investment in Taco Bell. Currently, hundreds of tenants working in dozens of different industries are housed in the thousands of retail facilities that the REIT owns across the United States. Because of the nature of its leases, which have lengthy terms and move property operational costs like maintenance, utilities, and taxes to tenants, Realty Income generates predictable cash flow and its occupancy rate has never dropped below 96%, even throughout financial crisis and pandemic, thanks to a concentration on great locations, a crucial component of retail success. The results of the A-rated corporation are further protected by its diverse portfolio of renters. Every renter pays less than 5% of the rent, and no sector pays more than 12%. Realty Income prioritizes long-lasting tenants with a service, non-discretionary, or low-price component to their operations. Even though Realty's income growth will never be rapid, the single-tenant retail property market's extreme fragmentation offers a wide window of opportunity for growth. This ought to maintain the monthly dividend growth and safety of the REIT. Number 3. Vici Properties. Since the company's founding 5 years ago, Vici Properties has raised its dividend each year. In September, the REIT with a concentration of entertainment properties increased dividend payments to investors by 8%. It presently offers a 4.6% dividend yield, which is appealing. Vici Properties anticipates increasing its dividend in the future. The business recently completed the books on a transformative year that saw it invest $22.8 billion in entertainment properties, primarily through the $17.2 billion purchase of REIT MGM Growth Properties, another entertainment property, and the $4 billion purchase of the Venetian Resort Las Vegas. The corporation has conducted minor acquisitions and development transactions totaling $4.5 billion. This year, the REIT has kept up its deal-making. It recently made a debut in the Canadian industry by purchasing 4 facilities in Alberta from Pure Canadian Gaming in a sale-leaseback deal valued at about $200 million. Despite all of the scheming, Vici Properties has the financial resources to keep raising its dividend and growing its clientele. That should make it possible for the business to continue generating alluring total returns. Since its creation more than 5 years ago, the REIT has produced an annual total return of more than 17% on average. Number 2. Stag Industrial. The dividend yield of Stag Industrial has increased to 4.1% as a result of the company losing a quarter of its value from the beginning of the year. For investors looking to generate regular dividend income, Stag Industrial, like Realty Income, delivers a monthly dividend. Also, the industrial REIT offers a dependable dividend. The business generates consistent and increasing rental income from its more than 560 warehouses and light manufacturing buildings that are essential to tenants' operations. Due to growing e-commerce usage and supply chain concerns, there has been an increase in demand for industrial real estate in recent years. As a result, the business has been able to achieve substantially higher lease rates as current contracts expire and maintain strong occupancy rates. With plenty of room to spare, Stag Industrial's rental income covers its dividend and allows it to keep some fresh cash flow to put toward new projects. Also, Stag has a strong balance sheet, providing it with plenty of cash to fund its growth. The business buys assets it can invest in and operate in order to create value and generate higher profits. Rent growth is complemented by these investments, allowing Stag Industrial to steadily raise its dividend. Number 1. Main Street Capital. One of the oldest and biggest business development firms, or BDCs, in the sector is Main Street Capital, or Main, which was established in Texas in 1997. The stock is also the only one on our list that pays a monthly dividend. As a BDC, Main Street offers loan and equity funding to relatively small, heavily leveraged businesses that are unable to access conventional bank financing. Since loan defaults soar during economic downturns, this industry is cyclical. Few companies have demonstrated the ability to protect their dividends when the tide turns, especially when combined with a high debt and aggressive payout ratios maintained by the majority of BDCs. The exception is Main Street, since paying out its first dividend in 2007, throughout a period that has seen 2 recessions, the company has never decreased its regular dividend. Main Street keeps a well-diversified loan portfolio with about 150 companies represented in order to safeguard its high dividend. Industry exposures are limited to 10% of the portfolio's value, and no investment is allowed to exceed 5% of the portfolio's income. This offers defense against unrest in a single business or industry. Well, that's about it for today's video. Let us know your thoughts in the comments section. If you found this video helpful, kindly click the like and subscribe button. Thank you for watching, and we'll see you in the next one. If you enjoyed this video, you're going to want to watch one of these 2 videos right here. Enjoy!